Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So this week's a really odd week. We've had a choppy market. We ran up on the back of CPI numbers almost 2 full weeks ago and have been drifting lower. Got back down to that same level that we peaked out on the Thursday, and now we're trying to rally again. So perhaps we can actually get something going in an upward direction. One of the positive things that happened this week was we actually started to break the big downsloping trend line. So markets are trying to break out of a sideways chop, and it's really difficult when there is no momentum. And one of the things that I've noticed is, so for example, last week the S&P was only down 0.69% on the week. However, if you go look at what happened inside the market, over almost 1,000 stocks were down more than 5% in North America, and only 313 or something like that were up 5% or more. So even though the market was hardly down, underneath the surface there was a lot of selling. Now, sitting here on a Tuesday after market close, the market actually had a pretty nice day on Tuesday, made up some of the give back on Monday, and so we're looking to see if we can finally break out of this sideways range, but it's been terrible choppy with no real momentum to the upside. So one of the things that we like to do over at Osprey Strategic is try to protect our capital when the markets really doesn't have a lot of momentum, and I'll be hosting a special event on that on Tuesday, November the 29th, talking about trying to protect your capital and only trying to ride the market when it's a lot easier, when it's trending higher. So if you're interested in that, I'll have more information out on that coming up shortly. I should have an article out on StockCharts this week, and there will be a link in there as well as on ospreystrategic.org. So if you like the work we do over at Osprey Strategic, you're more than welcome to come over and try it anytime you like. On the homepage, there's an offer for $7 to give you a chance to just go in and poke around and see our past newsletters, videos, and see what we're trying to do, and check out some of the daily setups that are pretty helpful for people. So with that, let me jump over into the market. What I want to cover off, first of all, maybe we'll jump onto the SPY. And so this is a 60-minute chart. And what you can see on this chart is that the market is working its way sideways. And what we had this big thrust on the back of the CPI, and we got up to, let's call it 282. Well, we were there this morning and finally started to rally up above that. Same thing over here on the S&P 500. We were sitting in around 394, and we've kind of been both sides of this. And so from 394, we started the day there and kind of worked our way up to 400. So a good day. S&P was up 1.3 and the NASDAQ up 1.4. What we're looking at, one of the important things to think about here is this a bull flag? And we're basically going to try and make a move up to the 200-day moving average. The S&P is right at it. You can see in August we kind of topped out at that level. So that makes it an important place for us to at least filter through. And if we look at the weekly charts, obviously, the 40-week moving average or the 200-day has been very solid support over the last couple of years. COVID was the only real exception until we got to 2022, and we've been living under that all year. So what we'd like to see, obviously, is a breakout above that and get back into a big bullish uptrend. I will say I do like the PPO momentum trying to improve here. But one of the real problems we've had is it's been so choppy. And even last week, what happened was, if you looked at the sectors that had outperformed on the week, it was the defensive sectors, the 3 top defensive sectors, which are staples, utilities, and healthcare. They were the big performers on the week. So no real help from that side of the market. And I think what we want to be aware of, and by the way, industrials have been doing pretty good. But when we actually, let me just go get that feature. So over here on charts and tools in StockCharts, you can scroll down and you can go to the PerfCharts and just grab the predefined groups, pick on sector ETFs. And then you can double click on this, how many days, and 6 days gives you the week. What you see here is relative to the S&P 500, the best performing sectors over the last 6 days, well, from November 15th to the 22nd, have been staples, healthcare, and utilities. Now, energy's been underperforming, and it had a nice rally today. I think XOP was up 4% on Tuesday. And materials actually pushed up nicely. Gold was up pretty well on Tuesday. So maybe we're starting to see a little bit of the middle of this start to do better, but you can still clearly see the staples. And if we just go back a day or two to the Friday, last Friday, it was really all dominated by the staples, healthcare, and utilities, and everything else underperformed the S&P 500, which was down. So again, we're in a choppy period here, and it really is difficult to try and, I read on Twitter, somebody said, just buy what's working and, you can do so good in this market. Well, let me go back 5 more days. And so you see November 4th to 11th, and guess what? It was way over here on the left that was working. And then we go forward, and what you see all of a sudden is it's the defensives that have been working and not the left. So as nice as it always sounds to just go buy what's working, energy has been one of the strongest sectors over the year, and it quite frankly hasn't got out of bed over the last, well, if we just pick a month or so. Here's 23 days. Energy's up 1%, and materials are up 6%. Discretionary and communication services really not getting anywhere, and technology has even beat energy. Now, again, stretch this out to, I'll call it 200 days. That might get us close to the beginning of the year. Yeah, I'm just looking up in the top left-hand corner here. So here's January. So energy up 82% on the year. But again, for the last month, it hasn't done anything really. So it's been more difficult. If we just slide this over a bit, we haven't seen energy do as great recently as it had been doing before. So one of the things that I think is important is to try and be aware if this might be rotating. Now, energy finally got a bid. Last week, crude was down 10%. It fell another 6% on Monday intraday, and then tried to rally into the close. Tuesday got a little bit more gasoline behind it, and we started to push a little bit higher. When you look at natural gas, maybe it's put in its low now and can start to rally. It was building a base here. What you finally see is it's back above its 200-day moving average, which has been uptrending and finally taking a big push. But literally only 4 days ago it was 573. Now it's up around 750. So this is extremely volatile. It traded up 9% on the day, and the PPO got into positive territory for the first time since September. So that's a pretty nice turn. Anyway, maybe we can finally see something happen in the natural gas space to get us going. Now, what we want to watch for here under the sector rotation model, again, if these are the 3 areas that were strong last week, and again, 1 week doesn't make a trend, and that's the problem. We've been floating back and forth all over the place between what's been working. What we want to watch for here, if interest rates are peaking, we're in the early recession stage, and it doesn't necessarily mean that the market can go a lot higher. I know there's a lot of people that think the market's ready to take off. Consumer expectations are terrible. Industrial production is falling. Well, we don't have industrial production falling. So if you look in here, what I want to show you is the industrial production here is still holding really strong at a very, very high level. So it's hard to say that the industrial production is breaking down. And one of the better sectors has been the industrial. So I don't want to kind of talk about it negatively. It's been pretty good. So the real question is if industrial production is still okay, it doesn't fit in any of these yet. The interest rate is probably the most obvious one. We're waiting for the interest rate to start peaking and rolling down. And then the yield curve is either flat or inverted. That's definitely what we have. And then when the stock market starts to recover, we're going to be in a full recession. Then the consumer expectations are going to start to improve. Industrial production would, quote, bottom out. And then interest rates would be actively falling, and the yield curve would revert to normal. So all of these things are tools that we can use. And I'm just going to go over here. On here, one of the things that stock charts have is the dynamic yield curve. And this is nice to just play around with here. I'm waiting for it to show up. What you can see on this yield curve is if you, we currently have the short-term rates higher than long-term rates. And yet if we take this slider bar over here and move it back, you can see, let's go back to just after 2020, you can see how the shorter term rates were clearly above or below the longer term rates. Then as we got towards the market peak here, we still had a very positive slope, and now we've actually gone negative. And so we'll watch for this to normalize. But one of the concerns I have is when this starts to normalize, let's just go back here. So we had a negative slope in here, negative slope. This is 06, 07. And then we briefly reverted to positive. But guess what happens? As we got to positive, that's actually when the stock market had more trouble. So it's one of those things we'd sure like to see the yield curve normalize. And then if the yield curve normalizes, then it's not necessarily that the stock market gets better for us at that point in time. So we need to really kind of watch where the puck is trying to go, or where the sectors are trying to go. We still haven't seen that much pickup from technology and discretionary, and we still have a lot of strength in utilities, healthcare, and consumer staples. I was hoping kind of 2 or 3 weeks ago that these areas would start to underperform the S&P 500 and we could quickly move over into this other area here. That hasn't happened as cleanly as I would have liked, that's for sure. I was hoping for something much more robust in terms of a transfer mechanism. Now, we also talked about consumer expectations, and it's always hard because if we go to University of Michigan sentiment, it really tends to follow, well, it doesn't follow the stock market, but you can see this is down here in the bottom right-hand corner, and at very, very low levels, and yet the stock market is still well above in terms of damage. This was a 50% drop. We've only had kind of a 25% drop, 28 on the S&P 500 at any time. And yet, so we're kind of half done, yet the sentiment is way worse than it was in 08. So really an interesting time here to see that. Now, when we go back and look in 1980-81, when we had inflation soaring and then the Fed came out and said they were going to fight inflation, that's actually where things reverted quite quickly, and the stock market made a huge run in 1980 and then pulled back for 81 and 82. So there's a lot of work to be done here to figure out exactly how this is going to work out. And again, if we were going to get this huge run from 1980 to 81, I kind of thought that's what we had. That was this run from the lows in 2020 to the top in 2022. But what we're watching for, obviously, is if the stock market can finally break out of that. So any sort of a break of this downward trend, I think we want to just keep in mind that that would be a much more bullish experience for us. The real question is, can consumer sentiment bottom soon? Would probably be the real question. Okay, all of that leads me to just say, you know, it's very tricky here trying to figure out which way the market wants to go. Again, if we go back and look at this market expectation here, you can see we were falling down, then we literally had a launch mode on one day, haven't done anything since then, kind of gone sideways. I don't want to quite say 10 days, but very close to it. Anyway, the S&P is back at the 200-day moving average. That was friction in April, that was friction in August, and now the real question is, can we get through it over here? Lots of questions about that. I had it was very interesting. One of my fellow technicians, who's not a big fan of using the 200-day moving average, actually posted an article on, or a tweet out on Twitter talking about how many sectors are moving above the 200-day moving average. Now, I just thought it was funny because he had kind of built a temple on who needs this 200-day moving average. But my point more broadly is it does work very quickly to explain what's going on in the market. If you're back above your, in this case, the black line on these different sectors, that can be very, very helpful. So if we start to look just real quick, we could go XLV and XLC and just check out these ones. So if we scroll down and look, here's healthcare clearly up above, and here's XLC communications clearly below. If we go to XLY and XLK, what we're going to find out is they're still below in both cases. Now XLK could potentially start to pop here. That would be nice. And one of the things that I like to watch for is this downsloping trend line to break on the PPO, and that is happening across the board in lots and lots of places. So it at least makes me want to be more bullish. But the fact is, when we chop sideways for 10 days in the middle of a bear market, it's very difficult to try and leave your money at risk through all that. So then if we continue and go to XLI and XLB, what we can see down here is industrials are well above their 200-day moving average or 40-week. They're almost at 6-month highs. That looks pretty bullish. And materials have been chopping around, and they look like they're about to start accelerating away from that 200-day. PPO is almost in positive territory on both of these, which looks very bullish. So, and we did see good price action from gold, but again, last week was the exact opposite. We had these big underperforming sectors rolling over quite hard and looking like the bear market was going to reignite. So it's nice to see them actually try to turn and start going higher. Now, if I look for XLE, which is energy and consumer staples, XLP, you know, again, we're just doing a back of the napkin thing here, but energy continues to be up in the top right-hand corner. It looked like it was going to double top. This week, it was really struggling, again, down 16% in a couple of weeks, and then all of a sudden started to revert higher. So maybe we finally made our low for energy, and we're going to take off to the upside. I got to tell you, it's been a very tricky trade for the last 4 or 5 weeks, hasn't done a thing. XLP, on the other hand, is just starting to push back above the 200-day moving average, so that looks a little more bullish. But again, you're in a defensive sector. So healthcare was above, XLP is above, and if we go look for utilities, XLU, and financials, what we see here is the XLU is trying to get above its 40-week moving average. It's been living below it since roughly September, and financials are just starting to work their way back above. So when we look across the spectrum, it's been the defensive areas, the right-hand side of the chart, that have been leading, or of the sector allocations over here. It's been over here mostly. Utilities and real estate are below their 40-week moving average, but they've started to outperform on a more recent basis. So all of this is lining up to me to tell me that we're trying to push over to this side, but nonetheless, it's been difficult. Now, the interesting part is industrials and materials are kind of two groups that are actually performing quite well. They're both above their 200-day moving average, and yet in terms of sector rotation, you know, we've totally missed the communication services, technology, discretionary starting to pick up. So it's quite odd to go straight to industrials and materials as an area of improvement. So really difficult. Again, the market is full of chop. So if you're struggling to make any money here, there's a reason. The market is not necessarily rotating as it normally would. So that's part of it. Doesn't have to, and it's not. But if it was to kind of help us tell us that we're getting to a market bottom and starting to work our way out of here. The bond market is not telling us that yet. We're not in a normal yield curve. We're still in a flat or an inverted yield curve. So we're still in early recession. And in early recession, the areas you want to own are utilities, healthcare, financials, and real estate. Well, real estate's clearly out of favor. Utilities are below their 200-day moving average. Financials just got above their 200-day. I think JP Morgan's probably one of the best charts out there. And healthcare has been going sideways. When I look at healthcare, it's not like I'm getting all excited to own it. Hasn't really been a huge performer. So all of these things are, let's just go get that healthcare. What we see here on the healthcare, it's pretty much really since April. I mean, today was actually finally a push above the November highs, and we haven't been able to break through this August high very easily. We've been trying since the end of October. Here we are near the end of November and finally getting going. So perhaps this is good to see that it's finally breaking out. But when you look at this chart, you haven't made any real money since July of 2021. So sideways chop, it might have a few weeks up and a few weeks down, but owning the portfolio for the whole period of time, you wouldn't have made a lot of money. I do want to talk a little bit briefly about the energy area. And one of the reasons I want to talk about it is First Solar has been doing really, really well. It continues to push higher. Last couple of weeks, it had started to just track sideways in here. And then on Friday, it put in a nice push, or late last week, it put in a nice push. And then this week so far, just holding. So the real question we want to make sure of, can it keep going? Obviously, it's been a wonderful run from 73 to 160. The majority of that, obviously, in the first week. So I'm quite hopeful that this energy space can continue to perform early into 2023. It's one of the areas that I want to watch in the market and just make sure it can perform. Again, this ENPH has been an outstanding stock, but really here's 224 back in September, and we're at 322 last week, 320 as of Tuesday's close. So we're just kind of chopping around here. And again, if this finally breaks out, I think it's going to be a really nice push. So watching for that to happen. Some of these other ones, renewable energy equipment, this one's called Array Technologies. It's trying to break through these prior highs. And it wouldn't take much, right? Just a move from 22 to 24 would get it to new 52-week highs, and perhaps this thing could finally get rolling. TAN, the solar ETF, has one of the strongest SCTR rankings. And what is that? The scooter ranking is like a sports ranking for ETFs, comparing them to each other. To me, it looks quite bullish. It looks like it wants to fire off to the upside, but so far it's just kind of pausing here. So I'm watching for that. And again, it wouldn't take much for that to push up and make new 52-week highs and really start to change from a downtrend to an uptrend. Steel Dynamics this week, companies like Air Products, Linde, all of those companies are really starting to push higher, and some of the steel companies started to show up on scans late last week and early this week, starting to show some more positivity and breaking out. So here's Steel Dynamics finally breaking out over the April highs. Looks pretty solid, and again, it's been trying to move up over the last few weeks. I would just say, like, this looks like an uptrend without this one on the end. It looks like it's just stuck in a sideways move. So nice that it's finally starting to move, and that could be a good clue that perhaps the steel companies are a good place to go. Lithium, this one's been downtrending for a month, so if you could catch it near the bottom and take it for another ride, these things move 30% quite quickly. Some other solar technology names. Again, clients of Osprey Strategic have access to this complete energy crisis list, and it's not just energy stocks. It's stocks from all over the place that are going to be part of the energy crisis and should do quite well. So we continue to watch those and provide clients those lists so they can go look for them. And if they're starting to break out, be aware of the different changes in trend. So again, sideways chop, what we want to start to see is something actually break out and really get going. Industrials are trying to do that, trying to get to new 52-week highs here. That's a pretty important level. But again, just be careful here because it's been quite choppy. You kind of buy in and it drops 10%, sell out because your stops get hit and it goes back up to 10%. So very difficult trading. Thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern Time. You can also see the recordings on StockCharts TV YouTube page. Keep in mind on November the 29th at 11 a.m., we'll be doing 11 a.m. Mountain Time or 1 p.m. Eastern. We'll be doing a presentation about how to try and preserve capital and be invested when the market has momentum. Maybe it's finally going to get some here. So keep watching and good luck. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.